The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, let's take a look at the market trade action at midweek. We found a little more strength in the grains and oil seeds after we started mostly mixed in morning trade Wednesday. Kind of quiet in livestock. There's plenty of external factors out here that we're watching as well around the world and here at home. So let's take a dive into what we're watching in the markets here as we get through midweek. Joining us now, Mike Zuzolo with Global Commodity Analytics is with us here today on Market Talk. Mike, good to catch up with you again, sir. Hope you're doing well.
Doing fine, Jesse. Thanks for having me back, sir.
Well, let's take a look at this, and I know we're going to try to paint some broad brushstrokes here as we've seen the grains and oil seeds in particular this week. Monday, really impressive move. Tuesday's move kind of faded. Then we found some more support on Wednesday. I know there's a lot of different factors at play here, and it's kind of feeling to me like we're getting the grains, getting some decent money flow. It's being met by some farmers selling on this rally. I guess just to kind of set this up, what's your perspective here in this grain and oilseed trade so far this week?
That daily trade you just talked about, Monday, Tuesday, Wednesday, I think it's really important to dissect that out because, what we're seeing now is continued weather supply issues drive these markets higher for the most part. Monday, after a very disappointing Friday and the Federal Reserve rate cut, wheat fell flat on its face. Monday came roaring back. Playing catch up with the Federal Reserve would be my assessment as far as why we mainly did that move back up in the wheat market. Then we fell flat on our face again on Tuesday, led by the wheat. And what this shows us, even with declining yields being reported more and more on my deck, on my customer accounts in the soybean complex, we still see the beans trying to go higher but failing because the wheat market won't let it out the door, won't let it out the gate. So whenever you tune into your show and I'm on it, there's probably a 99.9% chance we'll talk about wheat as the leader to this marketplace. And I'm still there because really the action, the price action, the data, the way we're trading, it suggests that pretty strongly. And I don't think you have to be really pushing an envelope in an analysis to see that linkage. And I think we're at a really critical time period where we've got a lot of South American weather on our side in terms of upside price, drought conditions. We've got hard red wheat weather that is very drouthy. We've got many of the major states at 60, 70, 80% drought, like Ohio. Indiana's at 80% drought. You're talking about both hard red and soft red wheat. Knowing that this hurricane system coming through is probably going to take care of the soft red wheat, but leave the hard red wheat literally high and dry for the most part. And so I really think it goes back to where we're at in the wheat market and where we are in the big picture and what the wheat represents, Jesse.
Good thoughts there. And thinking about the weather picture, we should touch on that a little bit more with Hurricane Helene making landfall Thursday. Obviously going to bring a lot of rain and impacts to the southeast and then kind of work its way up into the Ohio River Valley is what the storm track is kind of currently showing. You mentioned some of the South American weather concerns. So on one side, we got weather. Another piece, though, is logistical concerns that could be hampered by weather or strikes. We've already seen the strikes in the Port of Vancouver, and now we're talking more about strike potential here in the U.S. next week. I mean, just a lot of these external factors. Maybe talk about some of these between weather and other issues that are impacting this market, Mike.
Yeah, so where we are in my mind right now, Jesse, and have been ever since the beginning of 2024 calendar year, is stuck in the late 60s, early 70s into the mid 1980s in respect of the deglobalization, the trade fragmentation, commodities, agriculture commodities being on the tip of the spear, feeling the most sensitivity of this negative demand mindset that continues to plague us. We had the Federal Reserve as a major headwind. They're no longer limiting the risk on asset investment. And so we're really down to one thing. And China's all wrapped up in this because we saw how they stimulated their economy. They've done it a couple different times in the last month. And I really feel like that whether you look at Israel and what's going on in the Middle East, it feels a lot like 1973 and the Yom Kippur War, where it was an all-out Arab conflict against the Israelis, and that really set the stage for a spike in oil prices. Or like the graphic you just showed, we had a big strike back in the mid 1980s. We had a lot of strikes in the 70s and 80s. Remember the air traffic controller strike that Ronald Reagan shut down in 1981. I can go back and look at the geopolitics and the situation that the commodities are in right now, and it just feels a lot like the 70s and 80s, and therefore the demand is really questionable, and we still are relying upon, as I said, that supply and that weather market to rally us. And I don't see any end to that right now because of this potential of shutting down what I think there's 36 major ports, if I remember right, along the East Coast and the Gulf of Mexico. They could literally be shut down after October 1, and then all of a sudden our grain and our livestock and meat exports just go to zero immediately. I mean, that's the fear that I have. I'm not saying it'll happen, but it's a fear that I have that really keeps that demand trapped. And I think we just got to keep that in mind as we combine and as we see these really big premiums start to build back up, and how we are getting away from that 2014 price action that we were worried about up until 2 weeks ago.
Well, you mentioned wheat being the upside leader, and then you brought in crude oil there as well. I want to talk about those two together here for a minute. And let's first look at a chart, looking at the WTI stocks price. And I know I've been watching crude as of late, and Wednesday's trade, we kind of were drifting back lower. It looked like a little bit in futures. I mean, walk us through what you're watching in the crude oil market first before we tie in wheat here, Mike.
Yeah, I think we looked at this chart last week as well. We had just hit another new low in the crude oil stocks, and where the white arrow is down by the bottom right of this chart, we're looking at 413 million barrels of crude in supply, a brand new 2.5-year low today, another surprise drawdown in stocks. And this is with an idea that our demand is not that great and gasoline buying season is pretty much over with. I would argue, however, with the drop in the gasoline prices being pretty substantial around the country, we aren't ready for a further stocks drawdown, and we aren't ready for unleaded gasoline to leave and heating oil to be picked up on a seasonal basis with the fact that we're coming into wintertime. And so I see this 413 million barrel level, Jesse, as very tight and well below last year as far as where we were back in the beginning of this year, and a lot lower than what we want to be in terms of the 5-year average. And so I do think there is a tie-in between the wheat and the crude oil, in that the Russian ruble, and this is getting a little wonky, but I think that the oil and the wheat are the nexus to where we're going to find some demand bullishness in this market, or find the trend shift in this market. I'm sticking with wheat as my leader. I'm putting and attaching crude oil to that because the copper market did react very favorably to that Chinese rate cut. I think it hit a 2-month plus high this week so far. But it's the crude oil and the wheat that really are showing the negative demand mindset. And we have very tight supplies worldwide of wheat, and very tight supplies in the U.S. here of crude oil. And as I said, we've got this terrible situation brewing in the Middle East that could get a lot worse.
And that's a good point, as that situation in the Middle East continues to unfold. And we'll look at another chart here and kind of illustrate some of that correlation you're talking about here between wheat and crude. And I think this chart itself really kind of gives a good depiction visually here as we look at it, just some of the overlaid correlations here in recent history, Mike.
Yeah, some of the research that I've looked at and some of my own research would say pretty strongly that if you really want a good, long-lasting wheat recovery, and what we're talking about in the commodity industry right now of a demand low, you really do want the crude oil underneath the wheat market, because then the commodity index traders and funds tend to be a little bit more gutsy and invest a little bit more heavily. This would make a lot more sense with the Federal Reserve shifting to an easing type policy. But you got to ask yourself, why isn't the crude oil market going up right now with what could be happening in the Middle East, and as soon as this weekend or next week or whenever, as far as an all-out Arab conflict against the Israelis. And the simple answer is the trade is too nervous about the Chinese demand and the overall world demand for crude oil that they're not willing to take a step out there and buy into it. And I think these port strikes and this trade fragmentation and this deglobalization that we led the show off with really speaks volumes. And I think, as you say, you go back to 2020 and you look at the price action of WTI against wheat in this chart, and you see that a lot of times when you have some really good moves up in the wheat, it's usually at least supported by the crude oil market. So I'm essentially treating you like a client and a subscriber right now by going into this much detail. And there's a lot more to talk about, but we don't have the time.
Mike Zuzolo, Global Commodity Analytics, is our guest analyst here today on Market Talk. Mike, you mentioned South America weather earlier. Let's dive in there a little bit and kind of focus on this soybean complex. And I'll pull up a headline here first on our video feed. Thinking about, though, the dryness concerns in Argentina and Brazil, and maybe some talk here, Argentine farmers favoring soy over corn, according to new reports. Set this up for us and talk about some of the latest you're hearing right now, Mike.
This is the kind of news and information coming from the Buenos Aires Grains Exchange in the case of this article, Jesse, that really helps us understand who's the leader in this market. Because if we're going to rely upon supply and weather, yes, the beans can take us higher for a while, but I would not put too much stock in the soybeans with articles and headlines like this. The Grains Exchange down there is saying we're going to go ahead and jump up the soybean production to 52 million metric tons. That's going to be 3% higher, whereas the corn is going to be about 5% lower at 47 million metric tons. I see this as a trend in South America as a whole, whether it's Argentina or the center west Brazil, up in the northern center west areas where all the second crop safrinha corn is pretty much grown. If you're going to talk weather, it should be corn that you should be getting more bullish about when it comes to lost acres in South America and setting us up for a much better price action potentially in the December corn futures, especially if that wheat market can catch. And I'll circle back around to the hard red wheat because we've got weather issues in Australia. We found out from a private analyst today that they're saying that the Russians are behind in planting at an 11-year low right now in terms of planting pace because of drought. We've got our hard red wheat belt. Now you add to that Argentina getting clipped because of the wheat at this stage. You throw on top of that all this together, I would still argue wheat still has the best weather bullishness to it long term of all the three primary commodities. Right now, the trade's focusing on soybeans. That's fine, but recognize November 25 beans, they're banging on the door of $11 right now. Do we really want to let that slip away?
That's a very good point. I'll pull up a bean chart here as well. I know you got some correlations between 2024 and then 2014 as an analog here for November beans. And just thinking about this and your point you just made about, do we want to let, $11.25 beans slip away, et cetera? I feel like that there's been some opportunity here in recent days to make some catch-up sales, do some marketing, things like that, use the tools in the toolbox, et cetera, because to everything you've said so far, I would agree. Feels like soybeans got the potential here to kind of fade off this rally, barring support from the wheat markets.
Yeah, that's exactly how I'd set it up. And I'm not shortchanging what the beans have been able to do, because in 2014, on September 25th, we were trading close to $9 November beans. And so we're $1.50 higher than that at this stage of the game. And I'm all for that. My concern with buying the puts was not getting caught up in a blow down market exhaustion phase to the downside in the month of September. And I tried to keep the powder dry when it came to not making too many cash sales during this time period and just work the next 20, 30 days as far as my hedge analysis. So far, that's worked really, really well, because if I've, cost the producers that I work with 30 cents in a bean put, they're up $1 roughly at this point on the future side of the equation. And I think this goes in large part to the idea that we do have a little bit lighter yields coming in. August weather did hit us, but the big thing really is the fact that South America's got issues, and because South America's got issues, and because the dollar is at a 16-month low against the Chinese currency, the Chinese are buying again, and that's really what opened up some of the floodgates to longs jumping in there. But as I said, it's mainly weather, and as far as we go forward, I really think it's going to become more and more weather unless wheat and corn come around here.
All right, Mike, let's go over to the livestock trade. I want to talk a little bit there with you. I will pull up an October 24 live cattle chart for us to look at on the video feed. And I know, too, since the last time we talked, we got a cattle on feed report that largely kind of seemed like it was about as neutral as you could get. Your thoughts on that, and then what we're watching right now in October live cattle?
Yeah, I agree. And we had a really nice close last Friday, and the cattle and feed didn't disrupt that. And that was the nice thing about the Friday close and then the report, Jesse. My mindset has been that we can go higher into the end of the month of September. We're very close now to the end of the month of September, and we just struck a new monthly high in the live cattle on the front end just this week. And I think this is a really key time period to be watching to get hedges in place. Current clients had some feeder puts in place. Called a couple of them today saying, let's get some puts rolled up here. We can move up, several dollars for, pennies on the dollar at this point in our November hedges. Would like to extend those hedges if we can get one more push. But it's really about the calendar at this stage of the game since we're coming into the end of September. And I will say that the tailwinds of the hog market, the stock market, and the corn market, I think those are going to become really more headwinds as we get closer to the holiday buying seasonal. So be really defensive at this point would be my take, even though we are seeing the feeder cattle steer prices jump again and recover quite a bit. When it comes to the overall market, that cash market can hold up because the sentiment in the futures market is holding up as well. But that sentiment in the futures market has really been tied to Wall Street and some of the big economic data that's come through. And fortunately, a lot of it's been more positive than negative.
And I was going to ask you as well, thinking about some of that economic data. You mentioned Chinese stimulus earlier. How much of an impact has that had in our livestock markets so far this week, or how much impact could it have, Mike? What do you think?
I think the hogs and beef or pork and beef are set up for the best export market because of that 16-month high in the Chinese currency against the dollar in relation to our export sales as long as the ports stay open, Jesse. I think the problem with the stimulus is what I'm just talking about. If you have a 16-month high in your currency and you don't have domestic consumption and you don't have exports, that 16-month high is not going to help you with your exports. It's going to hurt you with your exports. So you're going to have to rely more upon the domestic consumption. And so my assessment would be they didn't do enough for their domestic consumption because the export market is getting harder for them to make the GDP go higher. So I'm glad they did it. They're moving in the right direction, but is it enough? I don't think me or the trade really thinks it is at this point, especially given the fact that the day after they release the stimulus, they shoot off an ICBM into the Pacific Ocean for the first time since when? 1982. So here we go again, 70s and 80s all over again.
Yeah, and that's just tie it in with everything you've been talking about here today. Is kind of that look at what are we seeing in commodities and livestock versus world events and things out there for sure. Mike, great stuff as always as we wrap it up here today. Anything final you would close with or reiterate to folks today?
Yeah, I'd say the grain stocks report's still very relevant, even though we didn't get to talk about it. I think most of the average estimates are dialed in. Remember that weekly corn chart does have a gap still below it from when the September went off the board at 394. Wheat filled its gap, but the corn has not. So keep that in the back of your mind.
Definitely. And if folks want to reach out to you for a conversation, take a look at your analysis and much more, I know they can find you very easily online. Mike, how can they get in touch with you?
globalcomresearch.com. That's globalcom with 2M's research.com. And you'll be looking at Jesse and me tonight on the blog post. But I'll be throwing in a lot more charts and graphics for the clients and for the subscribers. So please take a 2-week free trial.
globalcomresearch.com. With that, Mike Zuzolo, Global Commodity Analytics. Always good to talk with you, sir. Thanks for joining us today. Appreciate it.
I thank you for having me, Jesse. Have a great week.
Make sure to subscribe to the Market Talk YouTube channel. There, you can watch our latest interviews with the top market analysts in the country, find bonus content, and much more. Just go to youtube.com/markettalkag and hit the subscribe button, or you can search for Market Talk Ag on YouTube.